welcome back to AP Macroeconomics. Tonight is our last lesson before we head into review next week. So I'm really happy to be doing this with you. My name is Jen Rayfields. I work out of Ridge High School in Basking Ridge, New Jersey. And our topic for tonight is 6.6. It is the last topic in the course and exam description for AP Macroeconomics. And we're going to be talking about real interest rates and international capital flows. So the content objective for this evening is to be able to explain how differences in real interest rates across countries affect financial capital flows, foreign exchange markets, and loanable funds markets. So since you're already familiar with the loanable funds market and you learned about foreign exchange markets this week, really the newest thing here is going to be these capital flows. Okay, not much new tonight, a lot of review. We're going to be taking a look at how this topic is assessed in terms of skill 2B, which asks us to use economic concepts, principles, or models to explain how a specific economic outcome occurs when there are multiple contributing variables. Or we could look at it as what multiple actions could or should be taken if we wanted to achieve a specific economic outcome. So by the end of this lesson, you'll know that you've got it and you know you're ready if you can do the following things. You want to be able to explain the relationship between relative interest rates and financial capital flows. You also want to be able to depict financial capital flows using a loanable funds model. So that's really the newest thing for this evening. And finally, you want to be able to predict the effect of economic policy on interest rates, which will subsequently affect currency values and financial capital flows. So again, even though Unit 6 is not going to be on the 2020 AP Macroeconomics exam, in order to be an informed citizen, in order to be able to follow the news, especially news regarding international trade and open economy, global trade and exchange, you want to be really literate in terms of understanding the terms and definitions related to the flow of financial capital into and out of countries and how those affect exchange rates as well. And what that means for you. What does that mean for the purchasing power of your currency? So a lot of worthwhile learning objectives, even though this isn't going to be on the exam this year. So let's get right into our warm-up. We'll pick up with where you left off yesterday. So you looked at the 2011 question 2 and only part B. So we didn't need part A in order to be able to get to part B. So we just, in the interest of time and in the interest of making sure we focus on what you need to know, are just looking at part B tonight. So we are told that Japan, the European Union, Canada, and Mexico all have flexible exchange rates. Excuse me. And remember, fixed exchange rates are outside of the scope of this course. We're only talking about exchange rates whose values are determined by the supply of and demand for currency. So we're asked to suppose that the real interest rate in Canada increases relative to that in Mexico. So the first part asks us to use a correctly labeled graph of the Forex market for the Canadian dollar and to show the effect of the change in the real interest rate in Canada on the international value of the Canadian dollar. And they're even telling us how to label the y-axis here. So as soon as you see the foreign exchange market for the Canadian dollar, you know that you have to have quantity of Canadian dollars on your horizontal axis. And since we are looking at the international value of the Canadian dollar, we want to know the price of the Canadian dollar in pesos. So they've asked us to express that as Mexican pesos per Canadian dollar. So that's how we'll label our vertical axis. And if you want to use an abbreviation, you can use the standard symbol for Mexican peso and CAD. This is peso per CAD expressed this way. All right, so we also want to have our upward sloping supply of CAD curve, our downward sloping demand for CAD curve, and we want to find our equilibrium exchange rate before the change so that we can show the effect of the change in interest rates on the exchange rate. Well, as I'm sure you know by now, when the real interest rate rises in Canada, capital is going to flow into Canada. People would prefer to save their money, all else equal, in Canada because they'll earn a higher rate of return on their savings. So in order to purchase Canadian financial assets, people are going to have to purchase first more Canadian dollars. So that's going to cause the demand for Canadian dollars to increase, which we show by shifting the demand curve to the right. That's going to cause the equilibrium exchange rate to rise. The the price of Canadian dollars in pesos is going to increase. Now, based on that change in the international value of the Canadian dollar, how is that going to affect Canadian exports to Mexico? Explain. So if Canadian dollars get more expensive, Then the things that you purchase with Canadian dollars, like Canadian goods and services, are going to get more expensive. So just use some reasoning and some logic here. Once you've determined what happens to the currency, the rest of it should be pretty intuitive. So the increase in the international value of the Canadian dollar is going to cause Canadian exports to Mexico to go down. Right? Mexicans are going to buy fewer Canadian goods and services because they have become relatively more expensive to Mexican consumers. And these are key words whenever you're explaining how a change in currency values affects trade. You want to be able to explain that when the currency appreciates, the goods and services denominated in those currencies are higher, and the purchasing power of a foreigner goes down. So they're going to buy fewer goods and services from that country. Okay. All right, so we're going to get into a little bit of review from what you did earlier actually late last week when you learned about the balance of payments. So we've spent most of our time so far talking in terms of international trade about imports and exports. And we want to remember that when we're looking at the balance of payments, we're looking at the current account and the capital and financial account, and that debits represent money leaving the country. And so imports, which is the purchase of foreign goods and services by domestic buyers, represents money leaving the country and going to the country where those goods and services were produced. So imports represents a debit to the current account. Exports represents a credit to the current account. It's money coming into the country. When US firms sell goods and services to buyers in other countries or overseas, money is coming into the country, and so it's represented as a credit in the current account. Now, as you learned, there are other categories in the current account. It's not just the trade balance, but the trade balance is by far the biggest part of the current account. Okay. So then Mr. Romano talked you through a little bit about what's happening on the capital and financial account. We're just going to add some vocabulary here so that you understand what we are talking about when we're talking about capital flow. So when money flows out of the country, it's a debit to the capital and financial account, and we call it capital outflow or negative capital inflow. So capital outflow occurs when buyers in a domestic economy purchase real assets and financial assets in a foreign country. So the money is leaving the domestic economy in order for a domestic purchaser to purchase something in another country. Okay, so that's capital outflow, and it's a debit to the capital and financial account. Capital inflow is the opposite. It is when real and financial assets in a domestic economy are purchased by foreign buyers. That has the effect of money coming into the country. So we can distinguish between physical capital and financial capital, and we want to be able to do that. So when we're talking about real assets, and I loved Mr. Romano's example of assets that you purchase that you can't take out of the country with you. So if you buy a home in another country, if you buy a business in another country, if you buy a factory or build a factory in another country, that is a debit to the capital account. When people outside the United States purchase real assets in the United States, it's capital inflow. Financial capital relates to the purchase of financial assets. And so the most common financial asset you'll be asked about in AP in Principles of Macroeconomics class is the purchase of bonds, right? Interest earning bonds. But a stock is also a financial asset, and currency is a financial asset too. So when US residents purchase foreign stocks and bonds, that represents financial capital outflow. And when US bonds and US stocks are purchased by foreign purchasers, that represents money coming into the country. That's financial capital inflow. All right, so we're really just adding this language of capital outflow and capital inflow to what we learned about the balance of payments not too long ago. All right, so what do you need to know based on our topic for this evening? Okay, so the first thing you need to know is that a change in relative interest rates between countries results in capital flow. And that's kind of what we've been talking about. So ceteris paribus, or all else equal, when domestic interest rates fall, when they become lower relative to interest rates in other countries, demand for foreign financial assets will increase. There will also be a decrease in demand for the domestic financial assets. But we can think of the demand for foreign financial assets increasing because they offer a relatively higher return to the purchaser. That results in financial capital outflow. And when you have financial capital outflow, the current financial account moves towards a deficit. It is also true, ceteris paribus, that when domestic interest rates rise relative to interest rates in other countries, demand for domestic financial assets is going to increase, right? So if you can earn a higher real interest rate in your own country, you are going to be purchasing fewer foreign financial assets, and people outside of the country are going to purchase more of the financial assets from your country. So the demand for domestic financial assets will increase because they offer a relatively higher rate of return. So that results in capital inflow, money coming into the country, foreign purchasers of financial assets in the domestic economy, which moves the current and financial account into a surplus. It moves it towards a surplus. An existing surplus will get bigger. A deficit will move towards a surplus. So the conclusion we want to draw is that the owners of financial assets are people who are saving their money, right? What you have two options for what you can do with your money. You can spend it or you can save it. And the higher the real interest rate, the more likely you are to save your money. And when you're making that decision based on the interest rate, you're going to put your savings where you're going to earn the highest rate of return on that savings. Okay. And you'll remember back from Unit 4 that the behavior of savers is depicted in the loanable funds model. Remember that capital flow requires a currency exchange. In order to be able to purchase more financial assets in another country, you first have to have that country's currency. So when we have financial capital outflow, we're going to increase the supply of our domestic currency in order to be able to purchase foreign currency, in order to be able to purchase foreign financial assets denominated in that currency. That's the financial capital outflow. So when you have an increase in the supply of a domestic currency, the domestic currency is going to depreciate. You're doing so you can purchase more foreign currency, which increases the demand for the foreign currency, which causes the foreign currency to appreciate. Remember, currency prices are always relative. It's an exchange rate. You're exchanging one currency for another. They always move together. Capital inflow is the opposite. You would have an increase in demand for the domestic currency, which, as I'm sure you know and can predict, will cause the domestic currency to appreciate. And in order to purchase the domestic currency, foreigners must give up their own currencies into the foreign exchange market, which causes an increase in supply of the foreign currency, which causes the foreign currency to depreciate. So again, we're making these connections, right? We're tracking economic behavior and we're figuring out the steps that are taken in order to facilitate that economic activity. And then we're just figuring out what is a systematic way to walk through the effect of a change in behavior on a variety of different variables. All right, so finally, we're going to connect the capital flows to the loanable funds model, and this is pretty straightforward. You know that the supply of loanable funds represents the behavior of savers. So we're only looking at shifting the supply of loanable funds curve. When we have capital inflow, we model it as an increase in the supply of loanable funds. You'll remember that when you graph the loanable funds model, which is a hypothetical model, there are a lot of different ways to lend money to people. So there's no one marketplace, but we represent all of the availability of money for lending as the loanable funds market. So we're looking at the real interest rate. Savings is a function of your expected real rate of return and the quantity of loanable funds. So we have an upward sloping supply of loanable funds curve, a downward sloping demand of loanable funds curve, and some equilibrium real interest rate. When we have capital inflow, we model it as an increase in supply. Shift that supply curve to the right and then simply read your graph to find out what happens to the real interest rate. And as you can see, when there's an increase in the supply of loanable funds, real interest rates are going to fall. So capital inflow puts downward pressure on real interest rates. Capital outflow is modeled as a decrease in the supply of loanable funds. So you start with your initial real interest rate, and then you show a leftward shift of the supply of loanable funds curve. And remember, we're shifting this curve to the left. Kids often want to think about a decrease in supply as a shift up of the curve. But when supply is going up, it's actually shifting to the right, which looks like it's going down. So I like to tell my students that supply and demand increase and decrease, curves shift left and right. So we model a decrease in the supply of loanable funds as a shift of the curve to the left. We then see that that creates a shortage at the initial equilibrium exchange rate. The quantity demanded is greater than the quantity supplied. That's going to be eliminated by rising prices. And the price of borrowed money is the interest rate. So the real interest rate is going to rise when you have capital outflow. All right, so it's really just that simple. That is the one really new piece of information this evening. Make sure that you recognize capital inflow as an increase in the supply of loanable funds and capital outflow is a decrease in the supply of loanable funds. And you've got this, you're really close to the end of international economics once you've got that. All right, the last piece of the puzzle is the effect of monetary policy on interest rates. Obviously, we have talked so far about the influence of monetary policy on interest rates as well as fiscal policy on interest rates. But we're going to direct our attention to monetary policy because the mechanism of monetary policy is the interest rate. Right? That's not the mechanism of fiscal policy. A byproduct of fiscal policy may be an effect on the interest rate, but the mechanism of monetary policy is the interest rate. So we know that monetary policy is designed to be able to influence aggregate spending through changes in interest rates. So expansionary monetary policy causes the interest rate to fall, right? When the Fed increases the money supply, that causes the interest rate to go down. We know that's expansionary because it makes the things that people purchase with borrowed money relatively cheaper. So if you are going to buy something with borrowed money, and many Americans purchase cars and other big ticket items like washers, dryers, refrigerators, durable goods. If you're going to pay for something with borrowed money, a decrease in the price of interest, a decrease in the interest rate is going to make that good relatively less expensive. So we say interest rate sensitive components of consumption are going to increase as well as investment spending. We've already talked about why so much investment spending is interest rate sensitive. And those two things are part of aggregate demand. So if consumer spending increases and investment spending increases, aggregate demand is going to increase. But we've also now added this idea of what happens to capital flows when interest rates change. So expansionary monetary policy in an open economy that causes interest rates to fall is going to lead to capital outflow. So let's connect all the dots. The supply of loanable funds is going to go down, right? It's going to decrease. That is going to require people, right? People want to, when the interest rate falls, people want to buy financial assets in other countries. In order to do that, they sell their existing financial assets, right? The supply of loanable funds goes down. They put their domestic currency in the foreign exchange market in order to be able to purchase financial assets in other countries. The increase in the supply of the currency causes the currency to depreciate. And then we have this effect on trade. When the currency depreciates, exports go up and imports go down. And that's going to cause, I'm sorry, exports go up and imports go down. That's going to cause aggregate demand to go down because when currency depreciates, the domestic goods and services become relatively more expensive. So foreigners are going to buy more of them. Imports, on the other hand, are going to go down because when the domestic currency depreciates, foreign goods and services are going to become relatively more expensive. So we know that net exports is a component of aggregate demand. When exports goes up, aggregate demand goes up. When imports goes down, aggregate demand goes up. So you have both of these putting upward pressure on aggregate demand. So what you see here is this like nice reinforcing effect on aggregate demand of expansionary monetary policy. You get the domestic increase in spending because of the interest rates, but you also get the foreign increase in spending on domestic goods and services because the currency depreciates. All right, now let's go over and do the reverse with contractionary monetary policy, which we know is designed to which we know causes the interest rate to rise. So when interest rates rise, consumption, interest rate sensitive components of consumption are going to decrease, investment spending is going to decrease, and aggregate demand is going to decrease. In an open economy, when interest rates go up, what's going to happen to financial capital? Hopefully you said financial capital is going to flow into the domestic economy as savers in other countries seek financial assets denominated in the domestic economy. That is going to cause the supply of loanable funds to increase. That in order to purchase financial assets in this country, there's going to be an increase in demand for the country's currency. The currency is going to appreciate. When the currency appreciates, the domestic economy's goods and services are going to become relatively more expensive to foreigners, and foreign goods and services are going to become relatively cheaper to domestic consumers. Exports will go down, imports will go up, and aggregate demand will go down. So that is really putting all of the pieces of the puzzle together, right? We're taking monetary policy all the way through its impact on the macroeconomy, the domestic economy, as well as the impact of the changing interest rates on trade. All right, so I guess probably the trickiest thing in this unit is knowing what your starting point is and then figuring out what you're being asked to do. So work through the questions, always read the questions carefully and figure out what's my starting point, and then what is the next step in the sequence of events as a result of where I'm starting. All right. All right. We're just going to look a little bit about the effect of fiscal policy on interest rates. It's not fiscal policy itself that causes changes in the interest rate. It is the effect of fiscal policy on the government budget balance that does so. So I'm just going to walk you through real quick. An increase in the budget deficit. That sends us right into the loanable funds market, right? Because an increase in the budget deficit requires an increase in government borrowing. So an increase in the government borrowing is represented as an increase in the demand for loanable funds. We know that's going to drive up interest rates. When interest rates rise, capital is going to flow into the country. The supply of loanable funds is going to increase. There's going to be an increase in the demand for the domestic currency. The currency is going to appreciate in value. When the currency appreciates, exports go down, imports go up, aggregate demand goes down. And we know that when exports go down and imports go up, we know the trade balance moves towards a deficit. Now, one thing I just want you to think about, why might we have an increase in the budget deficit? Well, remember that the budget balance is a function of receipts, how much money the government is taking in, and expenditures, how much money is the government laying out. So we have government revenue in the form of taxes, government spending or outlays on government spending on goods and services, government spending on infrastructure, government transfers. So an increase in the budget deficit results when revenues relative to when you have less money coming in than you have going out. So if more money is going out or if less money is coming in, you're going to have an increase in the budget deficit, which is going to trigger that borrowing. So less money coming in could be from a tax cut. More money going out could be from an increase in government spending. What is increase in government spending and a tax cut designed to do? It's designed to stimulate the economy. Expansionary fiscal policy is designed to increase aggregate demand. But look what happens. If that expansionary fiscal policy is accompanied by an increase in the interest rate, you're going to get another crowding out effect. We talked about crowding out before. Crowding out is defined as the decrease in investment spending that results from an increase in government borrowing that drives up the real interest rate. Well, when you have an increase in government spending that drives up the real interest rate, you're also going to have this net export effect where the appreciation of the country's currency that results from the increase in the real interest rate is actually going to put downward pressure on aggregate demand as domestic goods and services become relatively more expensive to foreigners, and foreign goods and services become relatively less expensive to domestic consumers. All right, so that is really putting it all together. So the three things that we've sort of talked about is we wanted to make sure we understood that vocabulary of capital inflow, capital outflow. We wanted to be able to model capital inflow and outflow in the loanable funds market. And we wanted to be able to connect economic policies to changes in interest rates that would influence capital flows. Capital flows require currencies in order to be conducted. And so whenever there's a change in capital flow, you're going to have a change in exchange rates, which is going to impact your trade balance. Okay, that is a lot of pieces of a puzzle to put together, but we really just put that last one in. So I hope it is satisfying to you. So let's see if we can apply this to some questions. We'll start with just a few multiple choice, and then we'll finish up with a free response question. So skill 2B, I wanted to give you a question that allowed you to see skill 2B again, in this time in the context of this topic. So recent political turmoil in a foreign country has resulted in capital inflow to the United States. To counter the effects of the capital inflow on interest rates in the United States, the Federal Reserve can change the required reserve ratio, the discount rate, and open market operations in which of the following ways? So remember, these are the three tools of the Fed. So to counter the effects of the capital inflow on interest rates, well, what is the effect of capital inflow on interest rates? So if we have capital inflow, it means the supply of loanable funds is increasing. When the supply of loanable funds increases, we see the real interest rate fall. That could be pretty expansionary, right? A decrease in the real interest rate, trigger a lot of investment spending. If the Fed is worried about inflation or inflationary expectations, the Fed might want to monitor and respond to a change in capital flows through one of its monetary policy tools. So the goal here would be to put the brakes on. So if capital inflow leads to an increase in the supply of loanable funds, which drives down the interest rate, to counter the effects of that, the Fed would want to try to use monetary policy to put upward pressure on interest rates. So now that we know what the Fed is trying to achieve, we can determine which tools it would use and how it would maneuver or manipulate those tools. So we're looking for contractionary monetary policy, and we know that raising the reserve requirement, raising the amount of money that banks have to keep on hand, reduces the amount of excess reserves, right? Increasing the required reserves reduces excess reserves. So we want to raise the required reserve ratio. Same thing with the discount rate. Raising the discount rate makes it more expensive for banks to run into trouble meeting their reserve requirements. So raising the discount rate is also contractionary. It decreases banks' willingness to lend out excess reserves. So we're looking for raise the required reserve ratio, raise the discount rate. So now which one of these two is contractionary? Well, we want to make the money supply smaller, so we want to sell bonds. So E is the correct answer to this question. What makes it 2B is we've determined the outcome we want to achieve, which is an increase in interest rates. And we have to figure out how to get there through multiple means. All right, that's what makes this a 2B. Okay, so here's another question pulled from the question bank of publicly available questions. If the Federal Reserve undertakes a policy to reduce interest rates, international capital flows will be affected in which of the following ways? Well, if we reduce interest rates, is that capital inflow or capital outflow? When domestic interest rates become relatively lower, that's going to lead to capital outflow. So if the Federal Reserve, which is the United States central bank, wants to reduce interest rates, we're going to see capital inflows to the United States decrease and capital outflows from the United States to increase. So as is always recommended, determine what the answer to the question, figure out what's going to happen, then find the answer among the answer choices. So we're going to see that short-run capital inflows to the United States will decrease. We don't have long-run capital inflows decrease as an answer choice, which would have made this a really tricky question. But remember, monetary policy in the short run can affect interest rates, and we talked before about the long-run neutrality of money. So short-run capital inflows to the United States will decrease. There's a lot of agreement that in the long run, money is neutral and monetary policy doesn't have a long run impact. Okay, so now this is a skill 2A question. Under a flexible exchange rate system, the Indian rupee will appreciate against the Japanese yen when? Now again, before you look at the answers, what would make the Indian rupee more valuable to people? Why would people want more Indian rupees? Because in order for it to appreciate, the demand for it is increasing, or the supply of it is decreasing. So we're either looking at something that makes people more willing to buy Indian rupees, or we're looking for something that makes Indians less willing to supply rupees into the foreign exchange market. So if India's inflation rate exceeds Japan's, then prices in India are rising faster than they're rising in Japan. And so Indian goods and services are getting relatively more expensive. And so that would actually lead to a decrease in Japanese demand for the Indian rupee. So that can't be correct. Now, a trade deficit in and of itself doesn't cause currency values to fluctuate. So just by having a trade deficit doesn't cause a change in economic behavior. Now, what if Japan's economy enters a recession, but India's does not? So when an economy enters a recession, it's producing less output than potential output. And since we are producing less output, you require fewer workers. So income goes down. Japanese national income is going to fall. When national income falls, spending on everything decreases, including imports. So there's going to be less purchase by Japanese people of Indian goods and services. So there'd be a decrease in the demand for the rupee. That would cause it to depreciate, not appreciate. Now, what about if Japan's money supply decreases while India's money supply increases? Well, if Japan's money supply decreases, then the interest rate in Japan is going to rise. That would cause there to be financial capital inflow into Japan, financial capital outflow from India. So if Indians want more Japanese yen, they're going to supply more rupee in the foreign exchange market. That's going to cause the value of the rupee to fall, not rise. So we've ruled out A through D. Now, when we look at E, if real interest rates in India increase relative to those in Japan, well, that's certainly going to be the correct answer. Not only are all of the others not right, this is going to cause the Indian rupee to appreciate. So E is the right answer to that question. That was a hard one because you did have to sort of reason through the answers and figure out if it would cause an increase or decrease in the desire for the rupee. Okay, so I think this is our last multiple choice question. This is skill 3B. It's B because we're looking at two outcomes, multiple outcomes, and it's skill 3 and not skill 2 because we're given a cause and we have to determine the effect. So assume that the supply of loanable funds increases in country X. Okay, what's the first thing that happens? Increase in the supply of loanable funds, that's going to cause the real interest rate to fall. So if the real interest rate falls, what's happening to financial capital flows? You recognize financial capital is going to flow out. So if financial capital flows out, what happens to the international value of the country's currency and then the country's exports? So if financial capital is flowing out of the country, that means that there's an increase in the supply of the currency on the foreign exchange market. That's going to cause the value of the currency to decrease. So our answer has to be A or B. Now, if there's an decrease in the value of the currency, what happens to exports? Are exports going to go up or down? Well, when the currency decreases in value, it makes their exports less expensive to foreign buyers. And so exports are going to increase. So B is the correct answer to that one. Again, we're just connecting these dots over and over and over again. All right, so this is an FRQ. I went way back in order to find one that really focused on all the topics we've been working on this week. I also wanted to find one that was not graph-based, but explain-based as a way of helping you prepare for the exam this year. So let's just read the question and see how we would answer it. I hope at this point you feel really confident in the sequence of events, in the steps that we take, and these answers should be pretty straightforward for you. A movement toward a unified monetary policy within the European Union has led to an increase in real interest rates in member countries, but not in the United States. It almost doesn't even matter if you know what unified monetary policy means, because what we're told in the question is that we have an increase in real interest rates in European Union member countries, but not an increase in real interest rates in the United States. So real interest rates in the United States are relatively lower. Real interest rates in the European Union are relatively higher. So explain how the increase in real interest rates will affect each of these four things. So let's start with the purchase of U.S. financial assets by foreigners. Can you reason through this? Will people want more or less U.S. financial assets if the interest rate in the United States falls? Well, you recognize that they're going to become less attractive, right? So purchases of U.S. financial assets by foreigners will decrease because, and remember, when you're asked to explain, you have to have that word because in there to prove that the assertion you're making is true, because European financial assets now with higher interest rates will generate higher rates of return for savers than U.S. financial assets will. And so the purchase of U.S. financial assets will go down. Now, what happens to the international value of the US dollar when people want fewer dollar-denominated financial assets? right? Just rewording the question that way leads you into the answer. People are going to want less dollars. There's going to be a decrease in the demand for the dollar that's going to cause the international value of the dollar to fall. Okay. I actually find it kind of hard. I always want to provide my reasoning first and then answer the question. But I know the convention when you're responding to an FRQ is to give the answer and then explain. Either way, though, when I'm at the reading, if I read the explanation first and then I get to the answer, it still earns the point. So do whatever works best for you. Now, how about exports? Well, if the US dollar depreciates, then US exports are going to rise because they become relatively cheaper to foreign customers, and US imports from other countries is going to fall because foreign goods and services become relatively more expensive when the dollar depreciates. Again, those keywords here in this explain point are relatively less expensive or relatively more expensive when you're talking about the price of goods and services denominated in a currency whose exchange rate has changed. All right, so that's correct and complete answer to that FRQ. And that really finishes up our lesson for tonight. So let's quickly review what we did. This is the from the course and exam description for topic 6.6. And what the enduring understanding for this entire unit is that the interaction of buyers and sellers exchanging the currency of one country for the currency of another determines the equilibrium exchange rate in a flexible exchange market and influences the flow of goods, services, and financial capital between countries. We really spent our time tonight talking about financial capital flowing toward a country with the relatively higher interest rate, and we did that using the loanable funds market. And we connected monetary policy and its influence on domestic interest rates and connected that to financial capital flows. Again, we took a look at how 2B works. That's when you're given an outcome and you have to figure out which of several causes might have produced it, or you're looking for a specific outcome and you want to figure out which cause will get you there. All right, so now you should be able to explain the relationship between relative interest rates and financial capital flows. You want to be able to depict financial capital flows using a loanable funds market, and you want to be able to predict the effect of economic policy on interest rates, subsequent currency values, and financial capital flows. And that was our goal for this evening. I'm going to leave you with this question. This is from 2007 Form B, question 3. You should look at this with a lot of confidence. We're starting with real interest rates, and then we're changing them. And then we're walking through everything we just did tonight. So if you're watching live, go ahead and take your picture. If you're watching after the fact, go ahead and pause the video, give this one a try. And this will be the beginning of Monday's lesson next week when Mr. Romano and I head into review for the 2020 AP Macroeconomics exam. All right, finally, just that reminder about the College Board's determination to support all students who are interested in taking the exam on a device this year. If you or a student you know needs a device or has any issues connecting to the internet in order to be able to take the exam, please reach out directly to cb.org/tech. All right, thank you again so much for joining us. I'll look forward to seeing you next time.